Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're sharing 3 stories. First up, Elon Musk's SpaceX is shaking up telecom with a $17 billion deal for EchoStar's wireless spectrum, a move that's sending AT&T and Verizon shares tumbling. Then we'll explore how Google's new AI overviews are causing traffic for publishers like DMG Media to plummet by up to 89%. And finally, we dig into Klarna's dramatic IPO story, how the fintech once valued at $45 billion is now targeting just $14 billion, while one investor bets it will challenge Visa. Elon Musk's SpaceX just dropped a $17 billion bombshell on the wireless industry. The company announced it's buying wireless spectrum licenses from EchoStar in a monumental deal set to supercharge Starlink's 5G ambitions. The news sent EchoStar shares surging 19% in early trading. The situation presents a fascinating duality though. On one side, EchoStar's stock soared, while on the other, giants like AT&T, T-Mobile and Verizon all dropped, with some losing more than 3%. And if you think this was a friendly deal, you'd be mistaken. This is where the situation takes a more complex turn. Just months ago, SpaceX was firing off letters to the FCC, accusing EchoStar of leaving its valuable spectrum chronically underused. They went from public accuser to a $17 billion buyer, turning a regulatory battle into a market-shaking acquisition. Interestingly enough, this wasn't EchoStar's first massive payday from so-called spectrum squatting. The company was under intense pressure from the FCC to actually use its licenses or risk losing them. So what did they do? They turned that regulatory heat into a brilliant, if controversial, business strategy. Before this deal, they sold another chunk of spectrum to AT&T for $23 billion. In essence, EchoStar monetized assets it was being criticized for hoarding, proving just how incredibly valuable these invisible airwaves are. The deal also includes SpaceX covering $2 billion of EchoStar's debt interest. In return, SpaceX gets the firepower it needs for what it calls cell towers in space. Now, cell towers in space sounds simple, but believe it or not, the physics are a nightmare. Your smartphone is a low-power device designed to reach a cell tower maybe a few miles away. A Starlink satellite is hundreds of miles away in orbit. The signal loss over that distance is enormous. We're talking about a signal that's over 100,000 times weaker by the time it reaches orbit. To make this work, SpaceX needs incredibly sensitive satellites with large antennas and sophisticated software on your phone to handle all the complexities, like the Doppler effect from a satellite whizzing overhead at 17,000 miles per hour. It's a monumental engineering feat. SpaceX President Gwynne Shotwell said the goal is to end mobile dead zones around the world and will allow them to expand network capacity by more than 100 times. For EchoStar, the deal resolves a major headache. Now, an FCC spokesperson says this move holds the potential to supercharge competition and boost US connectivity. However, if you zoom out, you'll see another layer of strategy at play. When one American company aims to become the foundational communication layer for the entire globe, sovereign nations get nervous. Countries like China and Russia have already expressed serious concerns about a foreign-controlled network operating over their territory. In response, we're seeing a new space race, but for connectivity. The European Union, for example, is already building its own satellite constellation called IRIS to ensure it doesn't have to rely on a non-European system. This isn't just about ending dead zones. It's about who controls the world's information flow. SpaceX has already launched over 8,000 Starlink satellites. With this massive spectrum purchase, they're no longer just a satellite internet provider for rural areas. They're making a direct play for the global mobile market, aiming to connect boost mobile subscribers and beyond. This is the real reason the telecom giants are spooked. The long-term strategic threat is very real. Right now, Starlink offers download speeds between 50 and 200 megabits per second. A strong 5G signal can be 10 times faster or more, but here's the key. Starlink service is already good enough for most things people do on their phones, and it's only getting better. More importantly, it can reach anywhere on the planet, something no terrestrial carrier can ever claim. The fear is that as the technology improves and costs come down, Starlink could start competing not just in rural areas, but in suburbs and even cities, completely upending the traditional telecom business model. All of this leaves the legacy telecom giants facing a critical question: are they ready for a war with a company that builds its own rockets? From one tech giant shaking up an established industry, we now turn to another whose innovations are sending shockwaves through the world of digital publishing. Let's start with a single statistic that might just change your entire perspective on this fight. One of the world's largest digital publishers just told regulators that traffic from Google searches has plummeted by as much as 89%. The culprit? Google's new AI overviews, the feature that summarizes articles right at the top of your search results. Readers get the answer, and news sites that invested in the journalism get nothing. So the thing is, this is part of a much bigger trend that experts are calling the zero-click economy. The goal is to keep you on Google's page by giving you the answer directly, so you never have to click away. And it's working. Recent studies show that a staggering 60% of Google searches in the US and Europe now end without a single click to an outside website. This is critical because the entire financial model of the open web is built on those clicks. This isn't a minor dip. DMG Media, the owner of Mail Online and Metro, reported that catastrophic 89% drop in click-through rates in a statement to the UK's Competition and Markets Authority. David Higginson, chief digital publisher at Reach, which owns the Mirror and the Daily Express, puts the conflict bluntly. Publishers provide the accurate, timely, trustworthy content that basically fuels Google, and in return we get a click. Now, with Google Overviews, it's reducing the need for somebody to click through to us in the first place, but for no financial benefit for the publisher. He calls it another example of the distributor of information taking all the financial reward from the creator, and the fear on the street is that this is just the beginning. Higginson warns that if Google switches to a full AI mode, a new search style with even fewer links, the result could be completely quite devastating for the industry. To fight back, publishers are now racing to create what they call AI summary-proof content. They're building their own platforms like the Washington Post Arc XP to create direct relationships with readers. They're also using their own unique data and AI tools to uncover stories that a generic AI summary simply can't replicate. It's a move to prove their value in a world where search engines are no longer their partners. For its part, a Google spokesperson said the company prioritizes sending traffic to the web and that clicks have been relatively stable. But that's not the whole picture. The real turning point is a massive trust issue that's brewing. While Google claims stability, its AI overviews have been caught confidently making things up. We're talking about telling people to put non-toxic glue on their pizza to keep the cheese from sliding off, or incorrectly stating that Barack Obama was the first Muslim US president. These aren't just funny mistakes. One study found that 57% of AI-generated answers on life insurance topics contained errors. This raises a huge question of accountability when the AI gets it wrong. Publishers are escalating the fight. A group including the Independent Publishers Alliance has filed a legal complaint asking regulators to stop Google from misusing their content. This isn't an isolated scuffle. It's part of a much larger legal war being waged across the tech industry. The core question is whether AI summarizing copyrighted work is fair use or just outright theft. We're seeing major publishers sue AI companies for training on their content without permission. This legal battle is testing the very foundations of copyright law in the age of AI. This isn't just about clicks anymore. It's a high-stakes battle over who owns the front page of the internet. And now, a whole new field is emerging to fight this war. Generative Engine Optimization, or GEO. Instead of just trying to rank in a list of links, experts are now trying to reverse engineer the AI's black box brain using things like structured data and super concise answers to make their content more likely to be featured and cited correctly by the AI. This all raises a fundamental question for the future. What happens to journalism when the AI gives you the summary, but the publisher who did the reporting never gets the visit? Speaking of high-stakes battles over financial models, the fintech world is watching its own drama unfold. The story begins with a fintech titan once valued at a staggering $45.6 billion, now preparing for an IPO at a valuation of just $14 billion. That's after its value crashed to as low as $6.7 billion. We're talking about Klarna, and its story is one of the biggest dramas on Wall Street right now. A while back, we reminded everyone how fast markets can swing. Klarna's arc is exhibit A of that volatility playing out in real time. Now, get this. The buy now, pay later model has become wildly popular, especially with younger consumers. One survey found that 51% of Gen Z have used services like Klarna, often choosing them over traditional credit cards. But there's a catch. The ease of use can lead to overspending. The same study showed that about a third of those users admitted to spending more than they should have. This is the core tension at the heart of Klarna's business, and it's why regulators are watching so closely. The company is in the middle of a high-stakes identity crisis. Its own CEO is on the record stating he wants Klarna to be seen as a neobank, a PayPal wallet type of experience. This pivot to being a neobank isn't just a marketing slogan. It's a survival strategy. The core buy now, pay later business is facing a profitability squeeze and much more regulatory heat. So by trying to become a full-fledged digital bank with debit cards and savings accounts, Klarna is diversifying its revenue and trying to prove it's more than just a one-trick pony. The question is whether it's a brilliant strategic move or a defensive reaction to a challenged business model. But as it begs investors to believe in its new vision, the financial filings tell a brutal story. Klarna's net loss nearly tripled year over year to $53 million in the last quarter. Now, those numbers sound terrible, but what really brought this to a head was the next development, and it's the secret weapon that bulls are betting on. Klarna, you see, is also an artificial intelligence powerhouse. The company sits on a massive treasure trove of data about what millions of people browse, search for, and buy. It uses AI to analyze all of this in real time to decide who to lend to, and it's working. Research shows this. AI-driven approach has already led to a 56% reduction in credit losses. The losses are high, but their ability to manage risk is getting exponentially better. And the pressure is on. Its direct competitor, Affirm, is already profitable and boasts a market capitalization of over $29 billion, more than double Klarna's target. But just when you think the case is closed, the plot thickens. When we place Klarna's current struggles alongside an audacious claim from one of its major investors that it could challenge giants like Visa and MasterCard and be worth $50 billion by 2030, the contradiction seems obvious until you look at their hidden business. The reason for such a bold claim is that Klarna is quietly building a massive advertising business on the back of its data. Because Klarna knows what you're shopping for, it can sell highly targeted ads to merchants. That advertising revenue has exploded, growing from just $13 million in 2020 to over $180 million in 2024. That's the real story that could justify a massive future valuation. The upcoming IPO will be the ultimate verdict, leaving the market to decide, is Klarna a fallen star with a fatal identity crisis, or is it a deeply misunderstood giant on the verge of a historic comeback? As with any IPO and volatile market information, all data is subject to rapid change. As we've said before, this is not financial advice.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.